market crash. Do I buy now? Interest rates are too high. Should I wait to buy a house? I should really be following this guy Russ sells real estate for his content. Hey guys, thank you for joining me today. This is Russell Santos with the Gold Bar team at eXp Realty. With rising interest rates and people uncertain where this market is going, it's not a bad idea to make a plan so that you are better prepared for the future. And it never hurts to educate yourself during the process. So I decided that... And what's this? A trusted loan officer with experience for buyers in this market? And we are live. Hey guys, please welcome Greg Nouza, a loan officer with Nationwide Mortgage Bank. Greg, how are you doing today?
I'm doing just great, Russ. How are you doing today?
I'm great, man. This market is pretty out there, wouldn't you say?
Yeah, it's definitely an anomaly. It's not something that we're used to seeing, but that's what makes it so much fun.
How long have you been in the business?
Yeah, so I started in the business in 2002 with AmeriQuest. That's one of the many banks that fell back in 2007, 2008, something like that. But they were more of a subprime lender, and back then we were writing a lot of what's known as 228 loans. It's where the rate is fixed for the first 2 years, and then it starts to adjust after that. I don't think they expected rates to drop like they did over time. But since then, I've worked for about 12 different banks over my career. Banks, brokers, private mortgage banks. So I've been around the block a little bit. It's been about 20 years.
So when you mention subprime, one of the things that pop up is the movie The Big Short. Is that something you're familiar with?
It's funny you say that. I just watched it for I think the second or third time just last week. So yes, familiar with that.
I bring this up because a lot of people correlate what's happening now to what happened back then. Is that something that you feel that is going to happen in this current market?
Well, as far as what banks are going to let us write and how things move forward, you know, my hopes and suspicions are at least that they learned from the past, where I don't think that they're going to let loans get written as easily as they did in the past, as far as like dipping so far down on credit scores, allowing no verification of employment or income. I mean, some products still exist, but they require people to put like substantial amounts down. Like if someone's putting down 30% of the price of the home, it's less likely that person's going to default because they just have so much skin in the game, so to speak. So I think that that's definitely a variable. I think that they're also going to be looking for just ways to make it more affordable now that rates are going up. So I think that we may see like ARM loans starting to come back.
ARM loans?
I also just, so to explain that, ARM loan stands for adjustable rate mortgages, which is where you can get a more competitive interest rate for your customer if they agree to take on a product where for the first however many years, the rate is fixed. And then after that time period, the rate begins to adjust. Customers kind of acknowledge by taking those loans that they're only going to be in that loan for a shorter period of time. Assuming that rates go down later, they then refinance out of that loan into a fixed rate. So if they know they can get a better deal by taking a fixed rate for example, 3 years, 5 years, 7 years, or 10 years, that might be a better option as opposed to taking a 30-year rate now where that rate is higher and then ending up refinancing again in a few years. So it's just a way to get a better rate, assuming that the market's going to get better. So I feel like that's one thing they may introduce. But there's also construction loans. So for example, my bank just introduced on Monday that we're going to go and start allowing us to write construction loans.
Wow.
Which I've never had the good fortune of writing in my career. I'm mostly a residential lender. But now that I can do it, I'm excited to learn more about it. And that way I can serve as agents and buyers who are interested in being more on the investor side.
Yeah, eager to learn and grow and expand, basically, in a nutshell.
Exactly. But I think they're going to diversify more products. I just don't know if they're going to take on as much risk as they may have in the past.
So when you mention people having more skin in the game and putting like 30% down, what does that mean for FHA buyers?
Yeah, I think with FHA, where it's not a government loan, a lot of people think that the government is lending their money. They're not. The banks are lending their money, but the banks are insured. So it's a government insured loan. And it permits for banks to take on more risk than they would with other programs because the bank essentially is insured. And I don't think the guidelines are going to change on that. FHA, since I've been in the business, permits for 3.5% down. You don't even have to be a first-time home buyer. It just has to be your primary residence. And that even exists on 1 or 2, 3, or even up to 4 family properties. So I think that that's one of the inherent strengths of an FHA loan, where it lets people work with a smaller down payment. So I don't anticipate that piece of it changing. They have tinkered with things like the PMI insurance on FHA loans in more recent years. If you're not familiar with PMI insurance, that's where someone's putting down, essentially on an FHA loan, there's always PMI anyway, but generally it's because someone's putting a smaller down payment that the bank is taking on some risk. So I think it was about 10 years ago that they made it such where if you're putting down less than 10% on an FHA loan, this extra cost per month called PMI insurance just lasts for the whole life of the loan. So whether or not they tighten up on that or whatever, I don't know. I think that right now is an interesting time because 2020, which was the year that COVID came into play, introduced a lot of people that had some hardships. And I think all the defaults and foreclosures and things that may set banks back have really yet to kind of like be unveiled, because people were given like time and flexibility on making their mortgage payments. So I think as those default rates plus whatever the economy and the job rates are kind of really get uncovered, that's going to be something that affects us. But we're seeing it already in what the rates have done recently. They did go up considerably even just this month.
So exactly, this as of the time we're recording this, it's about June 15th. Where are we at the rates?
If you check different sources, you'll get different answers, and ideally it's also based on a customer's credit score and what kind of program they're going for and how much they're putting down. So there's a lot of variables. According to Google, the average rate right now is about 6.7. That is not my average rate. I mean, customers right now are able to get, I would say in like the mid to high fives, low sixes in that neck of the woods.
So a lot of the main, I guess, the questions I'm getting from my end, as far as my buyers, their main concern is if they were to buy now and say the market goes spiraling down, that's what they fear. Is that even a rational fear they should be looking at?
I think that fundamentally, at least when it comes to buying a home that you're going to live in, it's for the purpose more than just an investment. It's for the purpose of actually living there. And I look at that traditionally as more of a long-term investment. If someone's going to live somewhere short-term, they might even perhaps consider renting, only because the closing costs alone set you back a little bit. So I mean, whatever the short-term market movements happen to do, let's agree, in 20 years, that house, whether it went down in 2022 or whatever, 2023, it's going to come back up. It's just like the stock market, I would say. So like when I remember back to 2008, 2009, where housing prices really tanked, they came back up and eventually surpassed those numbers, even within a 10-year span. So that's where, in my opinion, it's something where the short term is always the concern, but the bigger picture is where to remember it's just long term, and that's where I think, again, if it's for the purpose of an investment, buy some stock. if you're trying to buy a house, then it's a glacier. It moves really slow, and that's where I think over time it'll come back if it does go down.
So one of the things that people don't realize is refinancing. Is that something people could do when they invest in a home with these current interest rates?
That's a really good question. I think that so many people are so rate driven that they lose sight of what the real number is. And the real number is the one that has the dollar sign in front of it and not the one that has a percent sign after it. Mm-hmm. And let's agree, like if somebody's at 3.5%, it's going to be really hard for them to want to put themselves into a 5 point something or a 6 point something. Like just that's hard to digest. But when we consider what the loan might be doing for them, that's really the right way to look at it. And that's how I'm not only trained as a loan officer, but that's just really how I feel after writing hundreds and hundreds of loans over time. So for example, if someone's just trying to get a lower rate, like they've had their mortgage for a few years, they're at 6%, and then they want to refinance and suddenly rates are at 3%, that makes a lot of sense. And the reverse would not make sense, right? Because if they're at 3% or 3.5%, why would they go up to 6%? The way that it could make sense for somebody is when, for example, if somebody wants to do additions to their home or make extensions to their home, and the alternative to taking a refinance would be a personal loan, which if you're going to try to get 100 grand or however much to do the rehabilitations, you're really going to get jacked on the rate if it's not a secured loan, meaning that there's no collateral, that it's not being held against something. So as long as it's a mortgage, considering that a personal loan, whatever, be over 10%, it may not be that bad, all things considered. An even better example, and this is where it really hits home, is, I've met clients where they have $20, $30, $50, $100,000 worth of credit card debt. And granted, their mortgage may be such where they're paying a more nominal interest rate, but these other credit cards are such where, most of it is interest to begin with, and the interest rate could be 15, 20, 25%. And so when we consolidate all those bills into the mortgage and we just get rid of all the debt, and now all that customer has is one mortgage payment, that mortgage payment might be hundreds, if not even $1,000 or more less than what they would have been paying when they had the mortgage plus all the individual bills. And meanwhile, paying all those individual bills was nothing more than paying the interest. Now, when we consolidate everything, now they're paying principal and interest. So at least it has a timeline where all the debt is getting paid down. So, again, it's all relative to the transaction itself. And I don't think people should necessarily be assumptive, especially if they're swimming in debt, saying, oh, well, shucks, I know I have all this debt that I'm really suffering with, but I have a 4% on my mortgage. No, I think that kind of customer needs some relief. And keep in mind, if you're able to put yourself in, say, a 6%, and meanwhile save $500 or $1,000 a month off your total monthly nut, you can then take that money and apply it towards your mortgage payment. And now instead of finishing the loan in 30 years, you might be able to finish that loan in 25 years or 20 years. And that's saving you a lot of money. And right there is extra value, in terms of how much you're spending over the life of the loan, as well as all your debt. So
I know you say interest rates is something that the individual shouldn't be concerned and focusing on the dollar figure. Now, what exactly dictates the rise and decrease of interest rates?
That's a really complicated question because ordinarily it's the 10-year bond note. And as much as we like to think that we can project what's going to happen tomorrow, forgive me, I'm going to tell this person I'm going to call him back. As much as we would like to be able to predict what's going to happen tomorrow, we can't always do that. And if we could, we would know exactly what to do on any given day, whether we lock in or not lock in. I remember at many different banks where management would get on a conference call with all the loan officers saying, hey guys, make sure you lock in your rates early in the week, because rates are going to go up at the end of the week based on the Fed and the 10-year bond. And so we'd all lock in as they had instructed. And next thing we knew, rates went down. And our clients are calling up being like, what the heck did you lock me for? We would have gotten a better rate. And so when we posed that question to management, being like, well, why did you tell us to lock? You said rates were going to go up. The answer, for example, one time it was, we didn't think that the economy would collapse in Greece. It's like, well, okay, it's like a butterfly wing creating a tsunami, if you've heard that expression. It's one of those things where there's so many variables, it's hard to predict sometimes. So to be honest with you, as a loan officer, I almost deliberately try to stay ignorant, in the simple sense that when we don't know what the market's going to do tomorrow, who am I to try to tell a client what's in their best interest? It really should be more where there's an appropriate time within any given transaction where we should be looking to lock in. Because if you lock in too soon, it can create other issues. Like if something pops up where there's an issue with title or an appraisal, or say the seller's just refusing to close and they need more time. So there's a million different scenarios. But yeah, I hope that's helpful.
No, honestly, I know that was a loaded question, so thank you so much for being so detailed about that. That was really great. I agree. I think it has to do with the human nature aspect of it all. People tend to get emotional over what tends to go on around them and not think logically, and kind of trusting the process when it comes to putting your faith into someone in your field. I mean, a lot of the times you're putting out fires, wouldn't you say?
That's exactly how it's been presented to me from some very high level loan officers that were like mentors and things, where we really are problem solvers or firefighters, whatever you want to call it. Because if everything went smoothly and easily, then first of all, everyone would be a loan officer. But second of all, it wouldn't be such a challenge to get a mortgage. And I think customers increasingly are driven by advertisements and rates, where, let's get real, like banks advertise by presenting certain rates. And so it almost has this perception like buying on Amazon, where it's like, oh, let's just see who has the cheapest rate. And what I say to clients is, like, if I was getting an intense, really complicated surgery, I wouldn't pick my surgeon based on who's charging the least. Like, that's a really horrible approach. And it's the same thing with my taxes. I don't pick an accountant because they're the cheapest. I pick them because I know they know how to do the job. And at the end of the day, like, the way that I operate with my customers, like, I have great rates, right? Like, overall, my clients come to me because of me, and they stay with me because of my rates. But at the end of the day, I can't be so focused on the rates where I have to pay attention to the surgery at hand first. Like, we can't really lock until we know that everything checks out. Otherwise, again, other problems come about. But of course, as a consumer, they don't see that side of it, where, like, all the issues that can transpire if the lock is done inappropriately or at the wrong time. So that's kind of where that's not shared on the advertisements when this bank is offering this rate, or we hear that the rates went down even though we already locked with our banker. It's something where we have to entrust that the loan officer is navigating to the best of their ability, and it's a trust fall. Yeah.
I think that sums up perfectly. When it comes to even thinking about buying a house, I think the first step, it's safe to say, is to talk to a trusted loan officer. And someone like Nouza that I've been working with for a while is someone you have to put your faith in. So no matter what you're saying, it's up to it. Every person is an individual, and not everyone should be looking at the interest rate, but as opposed to what your long-term goal is. And so would you say, with all that said, your first step is to talk to a loan officer?
Yeah, I think as soon as the idea pops into someone's head that they may want to purchase a home, and even if it's years out, I think that it's something where they can at least benefit from finding out some of the fundamentals. And I think that as much as the internet is helpful, it also can be equally misleading. It's chock full of either outdated guidelines or people who are, thinking that they're being helpful by sharing information where ultimately it may not be correct. And so, yeah, just to find out, like, how much money do I think I need to save up? Because let's get real, if I'm going to run a marathon, I'm not going to start training the day before. And if I'm trying to buy a home, I need to start saving money well in advance.
Yes.
And if I need to ramp up on my credit, I'd be best to know where my credit stands right now, so that way I can work on that, so that in 6 months, a year, whatever it is.
And obviously there's a lot of nightmare stories, but it's just, everyone's different. And where it comes to these rising interest rates, a lot of the times people say, when I should buy a house, the question you should be asking is, are you ready to buy? And whether you should be talking to a loan officer right now. And it's funny, every time, and you could correct me if I'm wrong, every time they say, what does loan officers do? I describe it that they are somewhat of a personal trainer. You don't know where your goal weight is, and you don't know how much you're eating until you have that consultation. Is that something that makes sense to you?
Yeah, you're absolutely right. You hit it right on the button right there. I mean, it's really a matter of ramping it up. And, of course, there's all these different numbers and what I would say ingredients that go into the calculations. But I think it's really three main things. It's where are you at in life in terms of somebody's needs and what they require. If they have a growing family and they're in a small apartment, then sure, maybe buying a house is the right time for them. Or say somebody is older in age, they've had a home or a large home for a while, and all the kids have moved out and they need to downsize. And that's another reason why some people would purchase. So that has nothing to do with markets and so forth. The next thing would then be, hey, like, do the numbers work? Like, do I qualify with the bank? And do I personally feel like the payment is something that I can afford? And do I have enough money to close? And then the last thing is, do I like the property? You know what I mean? Like, if we can't find anything that we like, then we shouldn't feel compelled to buy it. But I think those are the three main reasons why somebody should go ahead and buy a home. And notice how none of that has to do with where are the rates. You know what I mean?
Yes.
Like, I cracked the joke where it's like, when I decided to get married, I didn't get married because statistics for hepatitis was low. You know what I mean? Like, I got married because I found the one and it felt right. And so the same thing with purchasing a home. It's like, if you need it and the payment works and you like it, then you take the plunge, and again, it should be generally a longer term thing where whether rates go up or down, hopefully you can always meet the payment. And keep in mind too, like, whether the rate's 6% or 5%, that's not going to make a difference of thousands of dollars on the payment. it might be a difference of like, $300 or something like that a month. But I mean, at the end of the day, if we lose our job, we're not going to be able to afford that property, whether it was at 6%, 5%, 4%. And even if we were renting, we would still have a problem. So I mean, to a certain degree, we have to take certain risks in life as we move forward, in the same way that we contribute towards a 401k. We might end up losing money this year or next year on it, but the long-term goal is that we're contributing towards something that eventually is not just a place for us to live, but it's also it's also an investment. Again, I can guarantee my clients in 30 years they'll have no mortgage as long as they pay it and don't refinance it. So that's a nice feeling for me. I'm not guessing.
So obviously, you never know where you are unless you talk to that loan officer. And Greg, where can these people find you?
Sure. So I can be, first of all, reached 7 days a week on my phone. A lot of my customers really just deal through the phone. Unlike a real estate agent where it's a very physical thing. You got to be at the property. You have to set up an appointment. You got to get in the car. For me, it's really just a conversation where someone can reach me to discuss their income and their assets and so forth. And then they usually email me all their documents. So my phone number, if helpful, maybe we can put it on the screen right here, 516-698-0626. And some customers do like the idea of seeing me in person, so they certainly can come and meet me at my office, which is conveniently located in Wading River, New York.
Beautiful. Greg, Nouza, thank you so much for joining me. You've always been a pleasure to work with. I look forward to having more deals with my future clients and other clients to come. So thank you so much again for joining me today.
The feeling is mutual. I really appreciate you having me on, and I love this. You asked really great questions, Russ. And thanks for what I think would be very helpful for people.
My pleasure, man. It's good to know.